Hello, Warriors. Welcome to the best financial market webinar on the net, free or paid. Hi, Jay, is Hugo. Everyone doing okay? Saw that Blake's really going to dig into inflation today with the number coming up. Let me just show you a couple of things before I TO it to the guys. So, yes, Friday, talked about a move back down to this line from the 114 level after the NFP. And then yesterday we were talking about it, and Blake kind of agreed with me, not that it can't happen, but, you know, a lot of people want to try this line here at 1250. So, you know, Mark, it's more bullish if it doesn't get down there because it's not accommodating people. And I really do believe there are tons of stops for people that are bearish right here. And what's the significance of that? Well, the significance of that could be that yields might be through, or the majority of the pullback in yields might be close to accomplishing. I see the potential of little 3 drive here. Get some type of wedge from the highs, you know, something like this. And 138 was a real big level. That's where I have the blue straight line there. And the reason is, and let's look at it from a little longer term view. There we go. So here's this 136, 138 level where the breakout was. Now, I don't think it's going to get there. And if we're turning here, if you did a fib measurement, I bet we're near a fib here. I didn't do it. I'm a lazy guy. And the importance of that would be that it could provide, you know, if you're bullish gold and you feel like you missed it and you missed silver, that if we get that rise in yields, there'll be another buying opportunity in PMs. Everyone with me? Give me a Y if you understand what the narrative I just laid out. If the end's going to blow off one more time, take out stops above those highs, we should also get a pop in yields. And perhaps if the yen connects to the precious metals, well, it looks like it's doing today, that we'll have a chance to buy the metals on a break, probably above where they were. Silver's acting a little weaker. Maybe we get another test of this head and shoulders bottom down here. I didn't think that one day could do it. It could still be it, but I thought we'd have a little work around here. So that's it. Hi, Ryan. How you doing over there, buddy?
Yeah, morning, Dale. You good?
Yeah, good. You know, so we have some inflation numbers out today.
Yeah, we sure do. Looking for another move higher in inflation. It's been a bit sideways over the last couple of months.
Sideways from elevated levels.
Yeah. So
okay,
you know, signs of the top. If you like.
So maybe that's why there's some buying coming into the yen.
Yeah, I think we're seeing a bit of squaring up on the theme that we've seen post Fed.
Yeah.
You know, we've had the moves in yen, we've had the moves in yields, and now, you know, people are taking a bit of a pause. I think if we get an inline or soft number, we see yields, you know, take another battering, I think, because what we're into now is the market going to be pricing each data point as it comes through. You know, if it's higher inflation, then those rate expectations, you know, start coming up the calendar again. Yields move higher. If the data's soft, you know, the hikes for next year get pushed back down the calendar, and we're going to be in that the boat running, I call it. You know, when people run from one side of the boat to the other with each data point, and that's how.
So you think this data point? And good morning, Ryan, and good morning, Dale. I think I'm not sure. Hey. I was going to ask you just real quick, you know, since you're talking about the dollar and rates and a beat and, you know, possibly or a possible miss. So do you think that the risk is pretty much straightforward? You know, better number, stronger dollar, higher rates, pretty much, right?
I do. Yeah, but I think it's got to be a big number. You know, usually with CPI, anything that's 2 pips either side, more than 2 pips, you know, that tends to move markets. But because we're seeing big price moves, you're really going to be looking at 3, 4, maybe a 5 pip move or variation to the number to get that moving. So, take the CPI is expected at 5.8, up from 5.4 last month. The core is expected at 4.3 versus 4.0 last month. If it comes in 4.4, 4.5 on the core, or, that's not really a massive jump in inflation. If it comes in, 4.5, 4.6, 4.7, then we're back on the inflation train, and then you're going to see the market start to start repricing some of those rate expectations again. And conversely, if it comes in softer,
I was just going to say, just to give people a good idea of why CPI has become such a big deal for the market, is if you look at the data, just this is not core. This is just regular CPI. You can see how big the month on month prints have been. Right. This is enough to obviously freak out the market. Where if you're a technician, you're like, oh look, we're breaking all sorts of resistance. Right. And if you go over to this is the core CPI, which you can see, core CPI much more muted up until recent releases. So this is what Ryan is talking about. Like, we have to have some outsized numbers here in order for us to really shake up the market at this point, right?
Yeah.
Okay.
But also, given that we're just after the Fed, where they've kept rate expectations well grounded now, pushing the transitory line. If we do get soft numbers, if CPI comes in lower, then the market's going to continue what we're seeing here, which is probably buying more yen, yields dropping again, because the data's reinforcing the Fed's view. So we're always matching the data from now against what the Fed said. So if they say inflation transitory and core inflation goes to 5%, the market goes, you're talking out your ass, pal.
Yeah.
But if
vigilantes will be there.
Yeah. But if you drop under 4% in the core, say we get to 3.9, 3.8, then Powell sits there and goes, told you so. And the market goes, okay, you're right. So, but this is going to happen with each data point. So we could get a soft print this month, and we could get a high print next month, and the market's going to run from one side of the boat to the other each time we get these important data points, and we'll get the same.
Yeah, Richard just said, everybody is scared of inflation. I mean, inflation's a real thing. It's something we haven't really seen. Well, I want to say
really you were in diapers.
Since I was in diapers. I mean, but what's interesting is you think back when you're a kid, especially you, Dale. I mean, you're talking centuries ago. I mean,
come on, man.
I'm joking. But no, seriously, think about when you're a kid. Everybody listening in right now, like, think about when you're a kid, and think about what prices have done since you were a kid. I mean, God. Inflation is a part of life, and it's a part of. It is just what we deal with, right? And what we haven't seen really over the last 10 years, I want to say 10 years is probably a good benchmark. And, you can fight me on that data, because I'm just off the hip giving you this, is that over the last 10 years, prices have been very stable, right? And so
I would disagree with that, but carry on and I'll tell you my view afterwards.
Okay. Well, let's
cheap labor
minus education,
health, food,
and health.
Energy.
I don't know. I would say food, and I mean, maybe
prices and rent. I agree though. Clothing, consumer electronics, those have gone down a lot, but there are some things which are just ridiculous now.
And food, just because you become, just because you eat, vegan, organic, and you only eat peas, and you're a freaking vegetarian now.
I agree and disagree with you, Blake. I think you're right in
there's
many
certain
ways.
things, right?
Yeah.
Certain things, but yeah, you're right. I can't dismiss like the education and I guess where inflation has been elsewhere, but inflation is a part of life, right? It is. Everything does eventually go up, but it gets to a point, especially in this environment, where you will start to crimp the consumer at some point. I was just it was interesting. I went to go get a car wash, and my car wash. Well, we live in Arizona, so it's sunny here all the time. Everybody washes their car because it's like it to stay, because it's always sunny. So when your car gets dirty, you want it to look nice, right? We don't have rain that constantly, makes our cars ugly. Anyway, the reason why I'm saying that is our car wash has gone up 40% and like they jumped their prices by 40%. I'm like, holy cow. Now that's completely irrelevant to the fact that I want to point out that those prices aren't coming back down. Right.
Yeah.
And when you talk about inflation,
unless they go out of business.
Yeah. I mean, I guess they possibly could. I guess, their business slows down so much. They're like, shoot, we need to really attract new customers. We got to really drop our prices again. I doubt that's going to happen. I think the chances of that happening are less than 5%. But the point I'm trying to make is inflationary pressures that we've seen or prices that we've seen are probably going to stick. And it's not, when people think transitory, I think is not the right term to use, because I think a lot of people say, oh, it's transitory, it's only going to be up temporarily. Maybe the CPI or inflationary pressures are going to be, the pressure might be transitory, but it's going to stay persistent, right? I don't see prices reversing. And I don't know what your thoughts are here, but the reason why I mention this is because I think that if prices remain consistently, at these levels, that's really going to start to hit the consumer hard at some point.
That'll be a good thing. That'll be a good thing.
What do you mean it'll be a good thing? Explain.
Well, if you're worried about inflation, okay, and this is the problem that we have with central banks. If they see this troublesome inflation, they're going to act on it. Whereas instead of just letting the market get on with it, if stuff gets too high, if your car wash gets too high and people stop going, what's going to happen to prices? Yeah, what's going to happen to the prices of your car? They're going to think, well, we're not selling while we put prices up at 40%. We need to cut prices back. Yeah. So the consumer will lead what happens to inflation. But let's not be under any illusion that there are some big temporary factors in the market. Supply chains. We had lumber. We've got gas. Those things will drop out eventually. But it's what level of inflation we're left with, and like you say, the feed through from all that. If you get petrol prices jumping $40 or oil prices jumping $40-50, but that lasts a month, you're not going to have a big long-term impact. But when you get steady price rises that don't come back down in underlying things in production stuff, slowly that filters through to the consumer, because producers say, right, well, that price has gone up, we'll wear it for a little bit, but if we're wearing it for a year, we're going to have to put prices up. So you may get a year where producers don't put prices up, but then they get to a point where they have to, and then the knock-on is down to the next line in the chain, and then the knock-on is down to the consumer. That's why CPI is a lagging indicator. We're not trading what CPI is now. We're trading the price rises 6-7 months ago. But to the point of the consumer and the Fed, if the Fed act on it, they risk crimping demand and hitting the economy hard, instead of just saying, we're going to let prices go up. And when the consumer decides enough is enough, they're not going to pay the prices that are on the tickets. Inflation will drop back naturally. And the chain will go in reverse, because producers won't be going to China and saying, I'm not buying any more of your goods because I'm not selling them anymore. So your prices that went up last year 30%, well, I'm not paying them now. And so it goes back down the chain, if you know what I mean. And that's the natural order of things. But it's when central banks get involved and start acting on this sort of stuff, that's when the big problems arise.
So what are your thoughts here, Stelios? Any opinions?
Yeah, I think actually our friend Sansi wrote something which I agree. He says basically that innovation and technology is deflationary by definition. Things are more efficient. Things get they naturally drive prices down. But I think the problem that we're seeing now manifesting is something, like Ryan correctly said, something that's been building, and that's the classic definition, the original definition of inflation, which is the change in money supply, and that has been going up exponentially. So that, unfortunately, for that reason, I think we're going to have inflation sticking more than people think. And I think I agree with you, Ryan. Some products are going to go up in value, and then you're going to see inflation come back down. But for others, it's going to be a lot more sticky, simply because it's just catching up with with money supply and, things, what $1 buys you today compared to what it used to buy 20 years ago or 10 years ago. I remember when I came home back from London to Greece 10 years ago, 11 years ago, I remember going to the supermarket with 50 euros and getting everything and, having change. Now, 50 euros buys you nothing. So, so that's the problem. The purchasing power of currency diminishes, and that's an explicit inflation that we're getting. And the other thing, I've said this on the on this webinar, I think before, I did an MBA in 2002, so it's less than 20 years ago. It cost 15,000. Now it costs 50. That's not 2% inflation.
Right.
It's insane.
It is insane. Well, let's talk gold really quick, since gold's your traditional inflation hedge, and what we've seen is gold get right to really key resistance. I think every gold bull right now is rejoicing, and they're thinking, oh my God, it's finally here. We've been waiting for months, all of 2022 for this to come to fruition, and here we are, really back at, or I'm sorry, all 21 for us to come back to these levels since the summer. And here we are at, 1835, right back up against really key resistance. So what do you think pushes us over the edge? I mean, what do you think breaks us out? Because as of right now, I mean, I know it's ahead of key data. So that's why anybody who was, buying in Asia last night, it's like, oh, shoot, I shouldn't have done that, because, it's right up against levels that we've seen in July. What do you think puts us over the edge here?
I think a weak print will push metals higher. I think
you do. Okay, so now that's opposite of what conventional wisdom would tell us, right? Because
that's a short-term reaction for me.
Yeah.
Because okay, explain to us why you think,
because this is what we've been used to as the new normal for some time now, that if inflation is low, then QE and basically tapering will be delayed probably, and rate hikes go further out in the future. Rates are low, cheap money, risk goes higher, metals go higher, because real yields are going to be, well, actually, in the short term, real yields are very, very negative. And they probably will continue, but I think the market will initially take that as a positive. But I agree with you. I think conventional wisdom says the opposite. If you have high inflation, then your inflation hedge is metals. But I think because we're used to this kind of reaction, remember, any kind of reaction that pushes the dollar higher pushes metals lower. And I think if we get a low CPI print, is going to do the opposite. So dollar lower, metals higher.
Okay. Well, but didn't you just say if we have a lower print, risk assets are going to go up and gold's going to go higher? I agree with you that the dollar and gold are very opposite here. And I believe a strong print is going to be good for, it's good for, or it's going to be strong for the dollar. I guess we should put it that way.
Yes.
It's going to be bad for risk assets, and gold should go down, right?
Well, this is the problem that recently, last month,
it's tricky, right?
We have this knee-jerk reaction, always opposite. The dollar is opposite to gold. That's the problem I have with the short term. It used to be exactly what you say, but now I don't know which way. Actually, I don't know. You tell me where the CPI is going to print, and I don't know where gold is going to go. That's the problem. That's the problem I have.
Can I put it in? Can I put it in simple terms?
Go ahead, Ryan.
Simple terms, look at the price action. Gold's gone up while yields have gone down. Gold's gone up while the dollar's dropped. That's where we're at right this minute. That's all you got to worry about. If CPI comes in strong or weak, you watch the yields, you watch the dollar, and that will tell you what happens to gold.
So let's go ahead and match this up to the 10-year.
If CPI's weak and yields drop, gold goes up. That's where we're at. What happens tomorrow, a week's time? What happened previously? The view on gold and inflation is irrelevant. If we're talking about trading it right now, if CPI comes in soft and yields tumble, gold goes up, because that's what it's been doing the last couple of days, or since the Fed. And we've got a big level there. I'm half itching to have a short against this level, because this is one of these. It couldn't get through that level when we were talking about tapering and whether the Fed are going to be hawkish on hikes. You couldn't get up
Yep.
above that level then. And, here we are, it's a level, and a level's a level until it's not.
Level is a level is a level.
Can I say something and be really bold? I think while we're talking about gold, I think gold's biggest driver right now, and don't laugh, is Bitcoin and cryptos. Because like you said very correctly, Blake, weeks and weeks ago, you said, I think that cryptos are becoming an alternative to metals in terms of investment, even short term. And I didn't believe you back then, but I think you were 100% right. And there's so much money being poured into cryptos that I think if we start getting a leg lower, like a proper one, I think we're going to see a lot of funds going back into metals. So well done for predicting that, Blake. I really didn't believe you at the time.
Well, thank you. It's one of those things that I just, and this is as silly as it sounds, is just having conversations with my kids and other young, when I say youngsters, anybody, under the age of 20, which I've had a lot of conversations with, nephews and, just kids in general. And they're like, yeah, why would I buy gold? They all say that, every one of them. And I'm not saying that they're right. And I'm not saying that they won't be proved wrong, but right now that's their attitude until you give them, if right now they have a better solution than buying, some piece of crap paperweight that's expensive and it's shiny and it's in a,
you know what? I know there wasn't crypto around back then, but people were saying the same thing in 1999, 2000. Who needs gold? It's a paperweight. It's an archaic relic at $200 gold.
Well, I mean, like I said, who knows if they're going to be right or wrong, Dale. And I'm not here to really, just.
No, I'm just saying it's not new for people people saying that gold is an archaic relic that doesn't work.
But have we found a good alternative since? I mean, when's the last time gold's had a rival? And I'm not.
Yeah, that's
I don't know.
The dollar used to be its only rival.
What's that?
The dollar used to be its only rival.
Sure.
Or
and
money
there's obviously room for both dollar and gold in the market. And I believe there's going to be room for gold and crypto in tomorrow's market. Just how much gold is going to be, worth. And again, we're not here to debate that today. And I don't know if that's really relevant at this moment, but I do think cryptos and Bitcoin and Ethereum take a lot of the, I always use the term shine. It's so silly, but it takes a lot of the demand away from some of the precious metals out there. And I mean, here we go. Ethereum's almost completed its cup and handle pattern. Bitcoin, continues to, forge its way to the 127% extension and all new all-time highs. And I'm assuming on, any dollar weakness, we're going to see cryptos continue to move higher currently. So anyway, that's what I'm seeing there. Do you guys have any other further opinions on cryptos?
Great call by John Netto on Ethereum at 1,700.
Yeah, John Netto. Yeah, he was looking at Ethereum 7,000 is what he's saying.
By year end. I don't know.
By year end, shit. Yeah. Oh, sorry, we may be there. Didn't mean to say that.
I think cryptos are becoming more and more important. The problem I have with cryptos is that they're not used as a currency, right? The percentage of the trading use or transaction used as currency to buy stuff is almost zero, right?
I mean, I use my gold to buy cigarettes.
No. I am not comparing to gold. I'm just saying because people say, "Oh, Bitcoin is going to be the new currency; is going to replace the dollar." Nah. For me, at the moment, it's a collectible, a very, very easy to use. It's like, those baseball cards that cost $1 million or whatever it is. Very easy to use, very easy to transfer. Also, very easy to use to launder money and transact in places where you couldn't transact, or to actually move money out of the country, like the Chinese are doing, move it out of the country. So, it has so many good things going on about it. And I see exactly why, I can understand why it's being used. I just don't see the the intrinsic value behind it. I really don't. But, you know, I'm a dinosaur. I don't have to see it, but it is definitely a very important asset class at the moment, and there's huge flows going into it. So we have to take all that into account.
Yeah, we go back into that conversation that we had the other day about the metaverse, and like, look, I eat, sleep, poop. I get hungry. I have my hump days because it's Wednesday in the real world, not necessarily the metaverse. So I know we can all joke about that, but I guess the point I'm trying to make is that's a whole nother conversation that we can really have. But let's talk about some of these key levels going into the data. So the dollar yen's been hot on my radar. I think we're really bull flagging in a very impulsive bullish move. I still think any move down to 112.50 is going to be very well supported with the yen. I think yields are continuously moving higher globally, and so that's going to leave Japan behind at some point. So I think today's support really comes in around well, we have 112.75, which is going to be the support right here. It's channel support or flag support, maybe 112.50. If we get a really weak number, might dip to that. Got to watch yields. But any strong number is going to push us right back above 113.50, I think. One thing I also want to point out with the euro dollar, we have a bearish wedge developing here. So any strong data out of the US, the euro dollar is going to test that 115 level. Don't forget that 115 is really key for another reason. If you guys don't know here that this is the spike high post COVID comes in at 115 or 114.95 or whatever the number is. We also have 127% extension that is the 50% retracement. Long-term 50% retracement also comes in at that number. So a lot of big support at 115. Even if we probe to 115, you have to realize that before you just say, oh, I'm gonna let loose and I'm just gonna get long dollars because that was such a strong print. Just realize that 115's got a here's your big breakout point. It's a 50% retracement. Got we're near 127% extension. A lot of big levels there. Also want to point out in gold, we were talking about it, but I should really be very I guess clear on how big this level is. If you look back in July, September, we had one of our traders in our chat room last night, who's bullish gold, and he was talking about the bullish move, that was happening yesterday early on, when we were trading around the 1820 level, but we were around 1830 last night, and he's like, man, are all these traders going to get sucked in up here? And I'm like, it's been a big level of resistance. Like I wouldn't be buying there. What I'd like to see actually in gold is seeing a nice strong daily close above that resistance. Like if I was going to trade gold, which I'm not right now, I'm focused on some other things at the moment, but if gold got a daily close above 1835 on the spot price, like let's talk 1840, I think then that opens the door for a good 15-20 point move higher in gold. You don't need to capture it all, just capture the bulk of the trend if you can, especially after a pretty good move. I mean, we've gone from 1760 to 1830 just in a few days. So keep that in mind, where it was at just a week or two ago, where it is today, then you think, do I really want to pay up that price too aggressively? Anything else that you guys want to, I guess, I should mention the dollar MEX. It's been holding up really well. Still putting in a really good base, but also keep in mind that stocks look very iffy here because we hit that 161% extension. I still think you want to be a buyer on dips down to 45.50, but I wouldn't want to be long up here up against a golden fib. So what I'd rather do is buy a dip down, below 4,600. That's what, if I'm going to play on the long side, that's where I want to play. But on a move like that, that should create the dollar Mexican peso to push right back up towards 2050, 2080, 21 maybe. So just a few thoughts and ideas as we head into the CPI data. Any other thoughts, guys, as we come up with data here?
Got about 20 seconds to go, Blake.
All right, so I got the dollar yen 5-minute chart on the dollar yen. I'm gonna pull up the euro dollar and put up a 5-minute chart on the euro, and let me fix that chart. Let's go over and pull up the data flash. Here it is. Move that out of the way. Here's our charts. Here's data flash, and we should be good to go. We'll look at gold too.
Oh, it's higher.
Dollar.
It's
Boom.
beat.
Yikes. Okay, so what the data come out?
6.2 and 4.6 core.
Let's go pull up gold.
Wow.
So what is gold is slipping? What are yields doing?
See, I told you, the immediate reaction is the opposite.
Yeah, you're right.
We're jumping.
Yeah, there's gold taking a, ooh, man, how many people got sucked into that? Dollar yen is spiking. I know a lot of people have been shorting dollar yen, really thinking that.
Yeah. I said stop hunt above that high coming. Here we are.
It's gonna tear.
Yeah, the yen's going. I think gold is trading actually quite well given the number.
Gold isn't trading bad considering. Well, you know, it's holding up pretty well. There's the dollar yen, nice little spike up in the dollar yen. The euro, once again, we're approaching that 115 level. So just be really careful here. You know, I've been carrying a couple longs, you know, dollar Norway long for the last couple of days. And I also picked up the dollar MEX too the last couple of days. I've liked them on the long side. And you know, I was going to say too, just because, you know, I wanted to mention this before you bring up.
Yeah, Peter will give us the narrative. Yeah,
you just you know, crude oil. I think if you're looking at crude and you're thinking, okay, I think crude's going to consolidate some of these gains, and you know, we still are trading above the 78 level, but which is in my opinion very key support. But if crude, you know, comes back from 84 to 80 to 78, 77 bucks, I think that you got to be playing the way to play that in currencies is short Norway. And if you want to get rid of the dollar and say, well, screw the dollar, I don't even want to play with that, then trade the euro Norway. I think that's a bigger false breakdown. Nice setup from a longer term perspective as we are going to take out this previous support, current resistance. This is 127% extension, so we should rally from here back to the 200-day moving average. Anyway, I just want to leave you with that. I want to thank everybody for being here. Also, if you want to be part of what we talk about all day long, every day in our chat rooms, which here's like an example, the ForexAnalytix chat room. You can just see this is from, here's the time that I got up this morning, which was just about an hour, or got in front of my computer, not got up, but this is from where I stepped in right here just over an hour ago. When I say happy hump day, you can see all the chatting. This is just in the general chat room. That's not to include what's happening in the news and research room, what's happening in the trades room, what Ryan's team on the Forex Flow live room they talk more macro ideas, the Spanish chat room. So, you know, it's the biggest community out there, I think, in FX. And so come join us. It's only $1 for 10 days to try it out. All right, guys, thank you so much for everybody being here. Thanks, team, for being here and all your thoughts on the inflation data. Any last thoughts before we turn it over to Dale?
No, cheers, guys.
Nope.
No, well, that's it. Well, I'm going to let you guys do all the talking next time.
I want to hear Peter.
All right, Peter, let's bring him on. Dale, thank you so much for everything.
Okay, Blake, take it easy. Welcome back, Peter, my trading warrior brother. How are you?
Great, Dale. I'm really good, thanks. Yeah, how you doing?
Great, man. You know, it's kind of feels like a lot of things we're talking about. We're at, you know, some inflection points, and what great timing to have you on. I'm just like Stelio said, he wants to hear you. What's your narrative? What are you thinking here? What's center on your radar right now, Peter?
Well, what's on the radar? I suppose really the I mean,
share
from
your
a slightly...
screen, please, buddy.
Oh, sure. Yeah, let's do that. Yeah, let's do that. Yeah, that's a good idea.
Some of your accounts.
Yeah. Okay, that should. Oh,
okay.
I've got the wrong
there
screen active there. Hang on a thing.
Okay, that's a big call.
Yeah, that was the dollar, wasn't it?
No, that was S&Ps.
Oh, okay, that was the right screen. Okay, let me just do it again. Okay, so can everybody see my mouse hovering around here?
Yes.
Okay,
Yeah.
that's the right screen. Okay, yeah, good. Well, I think the bigger perspective, you know, one of the things which became very evident at the beginning of October was that we were just pulling down from September's highs into a correction on the main indices, you know, the S&P, Dow, whatever, the Nasdaq, and that we were going to get a higher high. And we were talking about at the time around 5-7% up from that low. And we haven't quite made it to the top yet. We've got a little bit more of a nudge coming. But the big take home that's really fascinating me is that when I look across all the asset classes, we can see a major top coming for the S&P up here. But it's also recurring, you know, in the 10-year Treasury yields, 5-year yields. We can see a sort of a very similar play in the currency side, particularly dollar yen. If you want to match up the dollar yen pattern from the pandemic low right up until where we are today against the US 10-year Treasury yields, that looks very, very similar pattern. But they basically are all giving us a very, very concise idea that once we get a little bit higher into December, everything's going to melt down. And I personally think that we're going to see quite a big shock. I don't think it's on the radar. The sort of the amplitude that I'm expecting to the downside is not really on the radar, apart from the perma bears that that you hear about day to day almost. But you know, aside in the rational world, where we're looking at sort of risk reward in percentage terms, you know, month on a month basis, I don't think anybody's really talking about the type of decline that I'm working with. Now, the reason for it is, in a way, it's Elliott based. So people tuning in today, if you're not Elliott wave based, I'll explain just a little bit here. When we take a look at the post-pandemic advance, I'm just going to put my tool into red so that you can see it better. When we take a look at the post-pandemic advance, the rally in the S&P, as is quite a few of the major stock indices, particularly in the US, some in Europe, they're unfolding into 3 waves like this. There was an initial 5 price swing subdivision up here into September last year. And the clue that this is a zigzag pattern, a 3 price swing event, is a very simple measurement. Just extend the first upswing, the first 5-wave upswing by about 61.8%. And if you get a successive 5-wave pattern coming up that follows it, that's in or around that sort of extension number, that's pretty much a good idea to define a zigzag. Now, why would a zigzag be unfolding in a new uptrend? Because basically the pandemic low was an intermediate 4th wave correction. If we go back to this chart, this is a weekly chart from the financial crisis lows. We've got a bigger 5-wave pattern development here. So the question is, when the 5th wave begins from the pandemic low, why are we getting 3 waves? You know, surely an Elliott wave model should be a 5 price swing event like this. 1, 2, typically 3 is the largest wave. You get 4 retracement and 5. You know, this, you know, we should be looking at something like this developing as the 5th wave. Well, the reason is because it's not an expanding impulse pattern where you get a typical 3rd wave extension like this. This is unfolding into a diagonal impulse. It's still consisting of 5 waves, but it's in a wedge-shaped formation. And if we take a typical look at that, let's go to wave search and have a look. Impulse diagonal ending contracting. This is it. It looks like this. So you have wave 1, 2, 3, 4, 5. It's in a wedge shape. And the subdivisions for an ending type diagonal, this is where it's either a 5th wave, for example, in a 5-wave pattern. The subdivisions, hey presto, look like zigzags, A, B, C, like this. So basically, what we've done in the last year and a half since the pandemic low is move up in a zigzag like this, and that becomes wave 1 of an ending diagonal. And the prerequisite, therefore, for this diagonal pattern to evolve is the 2nd wave is a big correction to the downside. So when you take a look at, let's put big price ratios in. When you take a look at the archetype, 2nd wave correction, it's normally a very deep 76% retracement. So it's a real shocker. if that comes through.
Do you have, I know, you know, you're not Nostradamus, but I know you're a thinker, and, you know, you're talking about shocks. What I'm seeing on the news, you know, what people are fearing right now is, you know, I know in Europe, you guys probably think we're babies, but people are complaining about $5 gasoline. And that's all we see on the news now is, you know, inflation is everyone's main concern. If we get this risk off move that you're looking for, are commodities going to be under pressure? Notice that maybe copper might be topping up here against gold on the ratio. Greg Horvat showed that chart. What do you think happens to inflation hedges during a sell-off in equities?
Well, absolutely. I think the sell-off in equities will undoubtedly bring a lot of these commodities downwards. Now, we just saw those CPI numbers come in. Here's the latest data. It's already gone in at 6.2. I mean, this is really big. But look where, I mean, look where the biggest the biggest component gain is gasoline. Look.
Yeah.
Now it peaked here in May, 56%. But that's really huge. And I think gasoline, but also if you put in, you know, energy as a whole, as a general energy move, it's still very large. You know, you got here 28.5% in May. But yes,
maybe Putin invades. You know, there is concern about what he's massing on the Ukrainian border again, and he has a lot of leverage on Europeans right now. In fact, the whole world with bottlenecks in energy. He supplies Europe with all their nat gas, right?
Yeah, well, I mean, I was just reading a report about that, and they were saying that actually the flow has really gone basically reduced into the pipelines through Europe, through Ukraine, and then into Europe by about 45%.
Wow!
And you know, that's
it's a
that's
big number.
Really, yeah, it's a huge number. I had a look at gasoline because actually I don't track it ordinarily, but because of the whole inflation aspect story, I decided to take a look at gasoline. Okay. And fascinating story, because this is our RBOB gasoline prices. And if you go back to the pandemic low here, you can see a very succinct 5-wave pattern. So from an Elliott perspective, 1, 2, 3, we have a bit of a sideways correction there, 4. And we just need a bit more for wave 5 to complete. And then next year, I think we're going to get this.
Wow.
We're going to get a big drop. So that means
the Fed will be able to say they were right about transitory.
Yeah, absolutely.
That's really interesting.
Yeah, I mean, these guys are bungling around, aren't they? I mean, let's face it, the Fed are as far behind as the tail of Taylor's comet. I mean, it's ridiculous, you know. I mean, but they're going to end up being right, which is ironic, really, because I think, yes, we're seeing these exact inflation pressures exert through gasoline and crude oil. Well, let's take a look at crude because, you know, again, while I was talking about the inflation story, let's have a look. And you can see that on crude oil, we haven't got a top yet. We've got to push up a little bit higher into December, I think.
Okay.
There's a shorter term diagonal pattern in here. It's a 5-way pattern. It's a bit like this. But so it's not quite finished, maybe not down on the downside.
So look at Peter's downside targets for the fall next year.
Yeah, this is where we're going to get to. We're going to get, this is only a 38% correction on a logarithmic scale, but it's a 60% drop in price.
Yeah.
I mean, that's
interesting.
That's huge.
And while this is going on, the dollar rally terminates. And will this surprise people? Should your wave count be right in the S&Ps that this time, should the S&P sell off, the dollar's not going to get a bid as a safe haven currency into next spring or summer?
No, I don't think it will. I mean, I think the dollar generally this year, here's this year's low in January, and it's been moving up in what we describe as a counter trend double zigzag pattern. We've got to get up to about 96 figure, somewhere up here. This is the 50% correction area, and we haven't quite finished yet. But I don't think we're going to see the dollar as a safe haven. I think we'll probably see the safe haven currencies like yen and Swiss franc. I think they're going to dominate the safe haven scene. But this time around, I don't think so. I think we're going to go through a dollar crisis next year, because basically we've been topping out on the 15.6-year cycle up here, 103.80. I've got a long-term dollar cycle to show you actually today. For those that haven't basically seen our work before, we do publish twice a year some really long-term forecasts, and we put a lot of cycle works in. This is coming from our mid-year report, and it only shows that the dollar's generally in a decline until about October 27. So we're basically sort of continuing to decline in this cycle period at the time. But it's long overdue for a bigger collapse. And we've been building baby steps to the downside. Here is the 15.6-year cycle top. We've had 5 waves down into 2018. It took, incredibly, almost 2 years to go up here in a second wave correction, and then collapse in 5 basically into January this year. And at some point, this is going to collapse. I think we're coming into that now. So I don't know what's going to trigger that necessarily. We can, make up some hypothetical reasons for that. But I think generally speaking, we've got to be thinking in terms of what is going to cause a dollar, basically a risk-averse dollar, and a dollar, basically a dollar run. I think we're going to have a confidence loss in the dollar as a benchmark global currency unit. Okay,
so maybe the economically sensitive commodities sell off, and the debasement hedge. I've heard the dollar be described, gold being described as a better debasement hedge than inflation hedge, because it follows more of the movement of the dollar being debased, whereas crude was a better guideline for inflation. Do you agree with that?
Yeah, I would, because as we saw from the CPI numbers, the chart just now, all of the CPI inflationary aspect is really built into energy. It's not food. Actually, the food component is lower than the composite, which today was 6.2. So you've really got it's really the energy aspect. If you can predict energy prices over the next, say, 6 months, you pretty much know what inflationary pressures are going to be around.
Okay. So we'll be able to get gasoline, but not be able to afford a steak and beans and corn. Are you tracking the grains at all, Peter? I know you
not really.
So many.
No, I'm not really.
All right, because I think there's going to be a problem with maybe food security. Maybe not as much in developed nations, but I think that's a possibility.
Well, I do see that from our institutional clients, because a lot of them are family offices, and they're all buying a lot of land at the moment to grow food. And
farmland?
Like farmland, yeah.
Yep. All right. So, we could set up an office in the barn. So anyway, Peter, we're getting a couple of requests, and I'd like to help people that that stuck around to hear you, because they've seen your work before. So your take on metals, gold and silver.
All right. Okay. Yeah, sure. Well, gold, let's talk about timeframes first of all. By and large, what we've seen since August, that's 10-year yield.
Wow, look at the 10-year yield's going to 6 in 5 years.
Well, yeah, we can come back to that in a minute. All right. Where am I? Oh, yeah, gold. Let's take a look at the bigger picture. Now, the August 20 gold decline, this is correction.
Yeah.
And the only question that I'm asking myself, well, you see gold's just breaking 1834.
Okay, it's doing it now.
So it looks as if we're going back up to, we're going to reach basically, I think, over the next months, we're going to get back up to about the highs up here. And once we trade up here, we might pull back in again as this drops. And I think this is all about inflation aspects. One of the curious things that I've had is that, back in the late 70s, I was trading silver and gold at that time.
Yeah.
So I was really in the thick of it with the bunker hunts, and the bunker hunts, buying silver like crazy, because they saw that as an inflation hedge. I think it's what's curious about gold though is that it hasn't really fired up, you know, in this inflation environment. And given the fact that
Blake thinks it's because of the flow of money into crypto. It's competition for gold.
I don't know. I'm not sure. I think the new era of cryptocurrencies. There's a lot of young people, you know, 40 under the age of 40 who are trading crypto, and no, I just don't. I think that's a new generational thing.
Okay.
I mean, it's very volatile and it tracks. Look, currency trading has exploded over the last 10 years because if you trade with a broker, he's going to give you very good margin against your deposits, right? And that's why it's exploded. And it's really in a way a similar thing because you got. I mean, it's a huge percentage game, isn't it? It's a casino, really. It's not a currency. It's a commodity, really. You can't really call Bitcoin and Ethereum and the others currencies. I mean, can you tell me any other currency around the world that fluctuates like that? No, you can't. Not even something from, not even some of the third world currencies, you know, trade that with that amount of volatility.
The Argentine peso every once in a while.
Maybe, yeah, could, yeah, maybe the Turkish lira.
Different colored money too. So, okay, so silver, please.
Silver, basis this, we've got. Here we go. Silver, we've got basically a bit of a triangle pattern. Goes back to the same August 20 high. So we've got basically range trading. We've got this breaking up. We've got a 5-way pattern developing from this September low. And we need to get the 5th wave up to about 25.16, and then we can pull back a bit, and then later in the year, maybe into the year, we'll get up to, I think 27.36 is reasonable. Somewhere up there. But we're range trading there. I don't think we've got an imminent breakout like this. So
the gold silver ratio would during this stage for the next 3-4 months favor gold over silver.
Well, it's favoring silver a bit at the moment because when we were dropping down, you see, I mean, basically the gold silver ratio moves alongside it's more or less directionally input. So I mean, if silver's declining, the gold silver ratio will widen. So here we widened out completely. And now that silver's recovering a bit, we're actually seeing silver outperform slightly, and it's narrowing the spread. I mean, the long-term spread on this is fascinating because I've completed some analysis a couple of months ago on this. I'll just show you quickly, but it's pretty neat. Let's take a look. Gold silver ratio. I think I've got it in here. Not that one.
Okay, wow. Yeah, because 40 used to be the mean, kind of the mean.
Yeah, this is it here. I mean, this is going back to 1930s, but when you take a look at this long-term picture, you've got this huge 5-wave diagonal, finishes here. So this is basically the end of the era where silver is, you know, basically is trashed. So this was the low basically around the pandemic low. Since then, we've traded down 5 waves. We're rallying. But you know, really in the long term, you don't want to be buying silver. You want to you don't want to be buying gold. You want to be buying silver, you know, because the spread's going to narrow.
Right.
So
same thing with the shares.
Yes, the gold miners look pretty strong. I mean, I think they're going to be outperforming GDX. Let's have a look at that, because I think we've still got some pretty big numbers coming through on GDX up here to about 100, over 100 into new record highs, basically. Yeah. And we've just finished a correction down here. So, you know, last month was the bottom. You should be buying this stuff really now. Yeah.
I remember. So, you know, you made a long-term forecast. So I remember some things that you were looking for, like 2780 was going to be a long. So, you know, from a year out, you're a point off on GDX for a buy point. and you always readjust things. So, you know, that's you have to. I mean, everything changes, but that was a nice call. So, yeah, buy gold shares and just go to sleep for 5 years.
Yeah, you don't even need to leverage, do you, when you've got multiples like this? You know, I mean, I've looked at the you know, the nugget. This is the 3 times bulls thing. You know, you can look at that if you really have got, you know, if you really can watch it day to day and, you know, keep an eye on it. But if you can do that, you can leverage even in these things. So, you know, they represent huge upside potential.
Yeah, and you know, it looks like it's going to go kind of hand in hand with your dollar cycle into 2025, 6, 7, like that.
That's right. Yeah, I think the dollar will assist. I mean, when you had some questions just now, were people asking about copper prices or anything like that?
No one asked, but I'm interested.
You're interested. Okay, yeah, we'll just have a quick look at copper because, well, actually, one of the things that's really, I mean, there's no doubt about where we're going to in the bigger picture. I mean, let's take a look. Here we've got copper.
Okay.
In a consolidation phase, it's
right.
a fourth wave. And
yeah, maybe like a little double top, but it's still got plenty to go. We have an interesting question here from David.
Yes.
Will the gold miners be unaffected by the risk-off move in S&Ps and Nasdaq and Dow?
Yeah, I think they will be unaffected. It's a good question because we were thinking exactly the same. And my impression is that that gold, as soon as interest rates top out, which they should at the same time, that's long-dated interest rates, I must add. But the long-dated interest rates, I mean, like 10-year Treasury yields, for example, or if you're here in Europe, you trade the Bund yields. But they should start turning down from a peak in December, the same time that equities and commodities start to fall. But it's quite evident that if we start then looking at a dollar decline, okay, dollar won't be safe haven. This is a misconception because we're hot-wired into thinking that the dollar will be attracting safe haven buying. It won't be this time around. I think we're going to see a complete opposite. The dollar's going to be declining. That's going to help gold very much. But the other tailwind for gold is, of course, lower interest rates. And if our inflation expectations are going to be that they're all going to come off next year, gasoline prices dropping down, oil dropping down, 10-year yields dropping down, then of course that's a very good tailwind for the gold stock. So yes,
and a big decline for U.S. dollar yen.
Yeah, well, that's right. And I was a bit slow on this one, I have to say, because on the uptake, because I was looking at dollar yen. We had targets originally earlier this year in January at about 121, and when the yen was weakening relative to the other major T10s, I thought, great, this is looking good. We're going to be we're on target up to about 131, but 121 rather. But then as the year has progressed and we haven't ascended into the same trajectory as we did at the beginning here, I realized that this upswing was developing exactly the same as the 10-year yield. It's a zigzag, A, B, C. And we're just hitting some targets today, actually, I think. And we should be, I think we might end up range trading here for another few weeks before we end up pushing higher like this. But basically, it looks like most of that downswing is finished. I think we had a target last week.
1272,
What did we get to today? 72. Okay, it wasn't too far off.
Close enough for government work.
But exactly. But look, this is what's going to happen. So the dollar will sell off and the yen will go bid, and it should pull us all the way back down to about 103. Wow. Something like that.
Beautiful long count. So, here's something else that's a little bit, counterintuitive. Khalid saying that you're projecting a 10-year yield to go to 6% and gold to an all-time high. Did I get that right?
Yeah, I think so. Because don't forget, we're talking about all-time highs a few years from now. Okay, so this is not tomorrow.
Right.
So
and either is 6% yields. Aren't you looking for about 210 and then yields to come off again?
That's right. I'm just going to get the because I was updating these just yesterday actually, because I'm typing up a report for the moment specifically on the outlook for yields. Let me just show you the because let me just get this right. Where are we? Here we go. Okay, 10 years. So this is my new 10-year yield chart. We go up to 2% by December.
Yeah.
Then we're going to drop down to about 87 basis points into the first, probably the first 6 to 8 months of next year. And then after that, into the final phase of what I call the inflation pop, where, this is the culmination of inflationary pressures that we're currently seeing now. That should last for the next 2 or 3 years as well. Then we'll get 10-year treasuries up to 5.6, and that should coincide with gold probably getting up to about,
and the dollar bottoming
and the
at
dollar
50.
Dollar bottoming at
If
50.
it exists. Do you think it'll exist?
Yeah, of course it'll exist. Yeah.
Will it still be considered a reserve currency at 50 in the Dixie?
Maybe not.
Yeah. Okay.
Mm-hmm.
So,
and that will be gold about
United States we become like a third world country, or like Germany and the UK.
No. Yeah. Okay. Yeah. You could feel it feels like that sometimes, but no. Oh God.
Or Greece.
No, we won't be. We won't be going that far. But I mean,
I
think that I think the US will lose its status as a. Yeah. I think we're going to see other currencies come to the fore by that time. Yeah.
Okay, it's good. And China.
Well, China, I mean, it's been.
Could that be the black swan, Peter? Because I know we're out of time, but back in 2008, they were the engine of growth to pull us out of the recession because they didn't have toxic paper, and they were still going to grow. And what the path that Xi is on, maybe he'll cool it until after the elections. But the deleveraging in China, if China could pull us out of a recession, can't it pull us into, maybe that's a black swan that could get that level down to 2,600, something out of China?
Well, I mean, I think that China still looks okay. I mean, look, if the Shanghai Composite was going to be collapsing lower or something like that,
yeah,
in some sort of black swan event, you'd see the Hang Seng collapse. And there's no doubt in my mind what the Hang Seng picture is. I mean, that's moving up. Like most indices will be doing in the next 2 or 3 years. So we're not hitting major tops at the moment. We're hitting interim tops. I think that this looks good for a move above into record highs. So this is really sort of, if you look at the BRICS index as well,
it's a triple almost. Yeah.
Yeah. If you look at I think this one looks good. I like Russia actually as well. And I was a big fan of Brazil in the last few years, but I've noticed that Brazil, whilst it could double after a correction next year to the upside, there's lots of other things that you could be trading if you want to leverage and get bigger multiples, into the final phase of the inflation pop. But I think China looks okay. I don't think it's going to. I don't imagine it being a black swan, because I think that would come up in the Hang Seng, and that's definitely not what I have in my in my counts on that.
All right. Well, thanks for straightening me out. So, I look, a lot of people stuck around for the interview. Peter, how could they follow you? And you're talking about you're just writing a report. So how they get in touch if they're interested in continuing to follow you? Well,
great. Thanks, Dale. Listen, if anybody would like to follow what we're doing here at WaveTrack International, then I'm typing up a report for tonight. We publish twice a week, so I'm doing it today for tonight's publication, and I'm also on Friday. We do that each week. And you can subscribe. It's called the Elliott Wave Compass Report. If you go to wavetrack.com, here's our main website, and go to subscription. Just click on subscription here, and Elliott Wave Compass. And here it is. It's $39 a month. And we have quite a lot in there. We pack quite a bit in there. And you can see that we cover stock indices, bonds, currencies, and commodities. Out of the main commodities that we do there really is gold, silver, and oil. And on the currencies, we do about 6 out of 10 on the G10s, and we alternate a bit there. And this is a really great way to follow what we're doing. Yeah.
Okay, Peter. Thank you so much for sharing long-term counts that people can remember and have biases for. And I appreciate you having a giving spirit, edifying the faith community today.
Great. Thanks, Dale. Thanks for inviting me. And it's God bless everybody. Yeah.
All right, man. Good hunting, Peter.
Thanks, Dale. And to you.
All right. That's a wrap, everyone. And have a great day trading. You could join the team in 11 minutes for the morning edge. Adios, everyone. You're very welcome, Anthony, Brock, Monica, And thank you again, Peter. Adios.